Hello, welcome to my webinar. This is hopefully a very important topic for a lot of you. The longer I'm in this space, the more I'm noticing that there are a lot of people sitting on cash that are sitting on the sidelines. The excuse and reason that I get more times than not is that rates are uncertain at the moment. Over the past 2 years, we've had hopes that rates would be coming down. We've had the reality that rates went up over the past year. Now they're kind of sitting steady. Um, Today is actually an FOMC day. Are rates going to be cut today? We don't know. But what I do know is that sitting on money, that's whether it's under your mattress or it's in your safe or it's in a money market account or savings account, or shoot, some of you might even have it in a checking account, is probably the worst decision you could make, even if you're uncertain. So, what I want you to leave here with today is a framework and a direction on how to look at things moving forward, so you don't necessarily have to make the perfect investment opportunity. The people that actually capture perfect opportunities is very, very small. Okay. What you want to be looking for is things that I'm going to lay out in this framework, but the the opportunity of what you're losing right now to inflation, and not only that, but the what you're losing out on potential upside, and it's compounding. So I'm going to go ahead and dive right into this. I want to thank everybody for taking the self initiative to be here, and that this is one step closer to hopefully financial freedom for a lot of you. So bear with me, my voice is a little shaky this morning, probably too much caffeine, but um, I'll jump into this, and at the end I'm going to host live Q&A. I can see the questions come up. If you're in the chat, can you please put a 1 in there so I can just kind of see my software is working correctly, and we will jump into this here. So why smart money stopped waiting for rates to drop. Okay, first order of business, this is not financial advice. This is strictly for educational purposes only. I'm not a tax advisor. I am not an attorney. And I am not telling you or encouraging you to do anything in this video. But here we want to start opening up and peeling back the can and start looking at the layers. Basically, if you're sitting on cash, historically, you're losing 3.2% year over year to inflation. So, in a nutshell, what does that look like? That means that if you have that money sitting there, its value is going down. You didn't lose dollars, you lost buying power. So that means that cash has to be in a position to where it's at least not losing purchasing power. Okay. So that means it has to increase in value at 3.2% year over year. And that is actually speeding up. That's historical since 1913. Those are the statistics, 3.2% per year. As of late, in the 2020s, it's speeding up to, I think, about 5 point something percent. And that's huge. That means sitting in a money market account right now is literally costing you money. You're not making anything. In fact, you're losing it still. So the forecast of rates are going to drop and I'll deploy my money at another time, that is an elusive opinion. And it may be true that you can get a better purchasing opportunity when you're making an investment. The reality is that even with high interest rates, you can still be losing the option to move forward, because what happens is you're taking this opportunity, putting it in a nutshell and putting it to the side, and that, if you would have just gotten into that opportunity, would probably be keeping up with inflation at a minimum. Okay. So here's an example. If you had $100,000 and let's put, person A and person B. Person A with $100,000, they're deploying $100,000 today. They're going to be locked into about their 8% interest rate right now on any asset they buy and investment they make. But they could probably buy something, worth probably $1 million with $100,000. Person two is going to wait 2 years. They're waiting and waiting and waiting just for the opportunity to come where rates come down back to 4.5%, 5% on a commercial product. Well, what does that look like in a nutshell? If we go forward 5 years from today, person A has already refinanced, cashed out, and bought their second property with the same $100,000. So now that person from option A now has two assets where person two is still waiting to get enough equity so they can refinance and cash out by their second opportunity. That's the numbers based off of today's rates. And that's the truth. So if you want to project a little bit further, person two is going to have exactly 15 months before they can refinance at the same cash out value as person A. Okay. So they're going to wait 15 months instead of 2 years. So they did save time on their investment and their ability to refinance at a lower interest rate. But what they did is they're actually 15 months behind the guy who bought today. And guy that bought today didn't lose anything, right? In fact, he could arguably say that he's got another asset under management, and now he's actually going to be compounded faster than the person who waited for rates to come down. So, what is all this boiling down to? If you look at our most recent, example of inflation being over 5%, since 2020, the dollar has lost, a fifth of its purchasing power. It's 20% there that it's lost since 2020. I don't think anybody that's sitting on cash has made up for that in any way, shape, or form, unless you got outside investments that are compounding and you're subsidizing that cash. Okay. In the 1970s, again, 50% of its value was lost from 1971 to 1979. People who sat on cash waiting for things to settle down are the people that lost 50% of their purchasing power in less than 10 years. The people that had real estate and they were backed and invested into something, they actually made money over inflation because the value of the real assets, in fact, the average house price since 1971 to 1979 doubled. Okay. So it didn't just replace inflation, it actually made money on top of inflation. So that's why looking at real estate is very important when you're trying to make an investment. So this is a reoccurring event, and with today's environment, I'm not expecting rates to go down at all. If they drop a quarter, basis point, I'm actually enthused. That's pretty cool. But at the same time, mortgage rates and lending rates in the commercial space aren't so much affected by the FOMC anymore. So that's really where things tie into the 10-year and things like that. But to recap on this slide here, we need to look at things from the perspective that if you're sitting on cash, you're not just losing to inflation, you are losing a lost opportunity on where you should be or could be. Okay. So going back to that example, don't be the person who's waiting for the rates to fall, because in this presentation, I'm going to give you the framework that you can use to start looking at investment opportunities. And none of this is directly related to, or am I totally enforcing the fact that you have to invest into real estate. Real estate is just one of the boxes here. Okay. So what does all of this mean? Let's dive into this a little bit further. Blackstone in 2024 They didn't wait for rates to fall. In fact, they bought AIR Communities. AIR Communities was a developer that they bought out. What did they do? They bought a developer who's building multifamily so that they could create appreciation and equity. They're building it. Okay. So they're building the equity because they know that they weren't going to be shopping around with another $10 billion to deploy into multifamily, that they could make as much equity as if they just bought this company that was going to build it. Okay. KKR is another one. KKR acquired about $2 billion of U.S. apartment communities in 2024. So what did they do? U.S. apartment communities was a brand that KKR bought out. That they did the same thing. They built things from the ground up, and mostly what they did was they actually, rehabbed some of the older infrastructure. So big players here are, they're not sitting on money. It's always moving. That's the key to all of this. Smart money never waits. And when I say never, they might wait a month because they're trying to build up some reserves, or they're trying to build the fund or the syndication, however that may be. But they're going to deploy it as fast as they can. They're not waiting and speculating on the rates. Okay. The framework is the RAISE, the RAISE opportunity. Okay. RAISE stands for real assets, acquisition below appraisal, the institutional vacuum, and surging rate proof demand. And finally, E is the emerging category upside. What does all of this look like? Essentially, these are 5 layers of opportunity that you're going to be looking at when trying to make an investment into something. Real estate can kind of cross over into a few categories, but for most opportunities, it's going to be a real asset. Okay. So, with that being said, we'll dive into each one of these one by one, and hopefully, you can start putting the piece together. None of these are in any particular order except for R. Okay. The first thing you're going to be looking at is that it has to be a real asset. That's the first thing you're going to be looking at to make an investment. All these other ones can kind of be in any order. Depending on the asset that you're looking at, you're going to kind of go down the line. So, with that being said, real assets, okay? To me, it's 99% something that's sitting on physical land, okay? Trailer parks, things that are sitting on that land but not permanently attached, that is a category, okay? So, real assets and real estate has historical evidence and factually always goes up in value. Why does it do that? Well, one could make the argument that that's because inflation is eroding the dollar, so it takes more dollars to buy the real asset. But that's exactly the point. The real estate is the opportunity where you're going to put the money so that you can beat inflation. That's how you get ahead, is you have to beat the inflation. If you're not beating the inflation, you're going backwards. Okay. I could even make the argument that some of you with your W-2 jobs, or you're being employed, or even if you own your own business, if you're not increasing your rates by 3.2% a year, historically, as of late, about 5% a year, you're making less and less money over time too, right? But being where the capital is headed is the first edge. Okay. So there's a lot of angles when it comes to real estate and real assets. The biggest one that I want to look at, when I'm kind of looking at investment opportunity, is permanent structures. Why permanent structures? Because I feel that, even in detrimental situations through natural events and disasters, foundations are very, very much always left alone. Okay. Trailer parks, a tornado hits it, they're gone. That's an insurance claim, I know, but at the same time, it's a restart. So for me, I rule out trailer parks and all that kind of stuff. There's good money in it. I'm not arguing that, but it doesn't fit this framework. Okay. Acquisition below appraisal. I know this one sounds silly, but this is often overlooked. Okay. One one thing that I want to point out here is that acquisition below appraisal can also mean acquisition below build cost. Um, Oftentimes, appraisal and build costs are very similar. It's kind of a homogenous relationship where they kind of try to keep up with each other, but at times build costs are above appraisal and sometimes appraisal is above build cost. So those two very much kind of stay in, the same equilibrium um, historically, because if they didn't, there'd be nobody ever building. If they didn't, nobody would ever look for that equity. Um, so there's a lot of things that you can acquire below appraisal. But that is often overlooked when it comes to just preliminary vetting a project. Um, for most situations, this is going to apply, but this is the perfect opportunity to dig down how much equity you can have in it from day one. Okay. The institutional vacuum is a huge one. Okay. In my line of work and the people that I talk to, there is a huge institutional vacuum coming to my industry. Um, and I'm not trying to persuade you into that. In fact, you probably don't even know what my industry is yet. But what you're going to be looking at are things where mom and pop, family members, relatives have invested into um, assets before institutions have arrived. Okay. So you're looking for fragmented categories. Okay. Things that are seem niche, things that, they're not mainstream because if they were, they'd be sucked up by the institutions. Okay. So you want to be looking at things that are kind of off the radar of other people. Um, for example, a big one right off the top is agricultural land. Okay. Buying the land that in order to turn it into something better is huge right now because the institutions are just now arriving. Okay. Big farm, data centers, all that kind of stuff. That is all being eyed by institutions. Surging rate proof demand. This one kind of goes back and forth between, surviving rate shock, but surging rate proof demand is assets that weather the storm. So if you can lock in a loan product on an asset, you can compound what your returns are going to be because you can put 20% down on a loan product that is going to be worth $1 million from day one. And from there, you can actually compound the $1 million, right? So the returns are actually severely incredible um, when you are tying all this together. So the rate shock is this: you're not going to be buying something that is volatile to the market. Okay. Real estate, people could argue that, hey, it goes up and down, especially you got buyers and sellers markets and things like that. And that's true. But at the same time, if you average things out over just a few years, the real estate goes up in value. Um, I know that's kind of a silly argument because most people who are investing are not looking at single family. Okay. Most people that are trying to invest are looking at, multifamily, at least a duplex. Okay. But the principle still applies there. When you start looking at multifamily on a larger scale, let's say you've got $1 million to invest, putting your money into multifamily, an apartment building, whatever it may be, is great because you can actually lock in your interest rate ahead of time. You can plan and speculate how much equity you have into it. And going into the next slide here in a second is what you're going to build and modify that property to become. All right. So Surviving rate shocks is very important. You don't want to be the consumer with an annual arm loan that is buying the arm loan and rates go up. You've just lost. You've totally lost. That's where people really get scared in this stuff. So there's options on the table that you need to just completely avoid, because if you're not weathering the storm when rates get volatile or we have a small economic recession, you're going to lose. But it's just a matter of how well you've protected yourself ahead of time. Point being in cash when the economy goes south is actually really bad. Okay. The engineered equity. Okay. This one's really, really, really big to me. Okay. You need to look at assets, hopefully, the real estate that institutions are coming into that survive rate shocks, and what you're going to do to those real assets to make more value from it. Okay. Here's a low hanging fruit, strictly, and this is a freebie for you. If you own a home in most areas, not everywhere, but you can put an ADU in your backyard. That's an accessory dwelling unit. You can increase your property value probably for less than you're going to have in that ADU, and you can rent it and start creating a return right away. Okay. A lot of people don't like that, and that's fine. But at the same time, that is a real investment you can make today, probably by just going to get a HELOC right now and making that happen. Now, I use that example to bring up the fact that there's a lot of assets that you can actually add value to. Those are called value adds. There's things that you can remodel. That's the fix and flip industry. Then you have things that you're building from the ground up, or you're modifying or just putting an addition on. Let's say you're buying a 2,000 square foot house. It is garageless. I don't advise putting a garage on a house because it adds very, very little value. In fact, if you could buy a house and turn the garage into a living section, you actually increase the square footage of the house and multiplied your value there. So building from the ground up is really big, but it has to make sense. You have to know your numbers ahead of time. You have to know who can do it, what it's going to look like, what the contractor is going to charge, what does the entitlement cost, what is the engineering, what does the horizontal development look like. All of those things have to check out in order to actually be net positive when you're developing or building. There's a lot of people out there that just buy one little lot in an area, and a couple will go into it and put a house in a developing neighborhood, and they'll cash out okay. But at the end of the day, people that aren't doing it themselves, if you don't have the vertical integration to be able to develop and build, like if you and your wife want to, or your husband, you want to buy a lot in a developing neighborhood, build it, you are restricted by red tape, the things you can't do, what you can't build. You might have to follow a developer's build sheet. There's a lot of restrictions when it comes to that. So now you're fixed on not trying to save money, but now you have to bow down to the person that developed the land. At the end of the day, you paid everybody to do the work. So the only people that actually made the most profit on it is the developer and the builder. Okay. You must be able to have a system in place in a lot of those situations to where you are the general contractor, you are hiring the subtrades directly, and you are employing everybody. I don't mean every single person, but most of it. Your framing, your concrete, all those kinds of things have to be tied into a vertical integration of being able to capitalize that. Because if you don't, you're losing money, or your investment return is very low. Okay. Doesn't mean you won't walk away with some. At least that is better than sitting on cash. Okay. So, what can you look at that institutions are coming into that is a real asset, that survives rate shocks, that you can add value to? Make sure that value you're adding is going to cost less than the appraisal of what it's going to be. All right, very big. Honestly, on this one here though, this one is so underrated because it's often overlooked. Most people think that this has to be a fix and flip, and it doesn't. So there's simple things like taking, um, buying 5 acres and splitting it down and simply just reselling those lots. Okay. By doing that, you've now just almost overnight created more value because you can ask more for 5 lots from those 5 acres than you can for just selling the 5 acres. Where this is all kind tying back into here is that I wanted to create this framework for you to be able to start looking at things with a lens of education. Okay. Earlier on, I said that, these boxes, the RAISE method, you don't have to fill every box, but the more boxes you fill, the better it is. Okay. I actually have a product and I'm in an industry that checks all 5 boxes. If you would rather look at what we're doing than try to do all of this yourself, scan this QR code and it'll be actually really easy for me to get into a call with you. I can either jump back into this framework with you, give you some education, and I'm not pitching you anything here, just just trying to create alignment. Because at the end of the day, you need to get out of cash. Whether you deploy that into other investors like me, people have funds or syndications, me or anybody else, or you're investing into, hopefully real assets yourself. You have to get out of cash, and the sooner the better. Sitting on cash is the worst thing you can do. The saying goes, cash is trash, and those who wait are the ones that lose compounding results. Okay. You've all probably heard it if you work a W-2 job or you're employed and you have a employer investment retirement account. The earlier you get in on that, the better, right? It's just math. So I hope everybody has kind of an understanding of what to look for here when they're looking at real assets and how to invest. Again, it doesn't always have to be real estate, but you want to make sure it's a real asset. Okay. A lot of stocks fall into this category, but really they're kind of the stocks that are the mom and pop level stocks because institutions haven't vacuumed them up yet. Okay. You want to be in there before the IPO. You want to be in there before SpaceX does a huge correction after its IPO. That's the type of example I'm illustrating for you, because the earlier you're into something that has huge upside, is it risky? Yes, all investment is risky, but getting into those has the opportunity for the most upside. Okay. I'm going to go ahead and leave this up on the screen here. And I'm going to see if I can't jump into some Q&A, because I'm sure somebody has questions. All right. No questions. Anyways, that's going to be a wrap. Thank you, everybody, for coming into this. And I wish you all a very blessed day. And I'll catch you in my next webinar.